So, um, if you think back to early 2022, the global economy looked like it was staring down the barrel of just this multi-decade disaster.
Oh, absolutely. It was terrifying.
Right. I mean, oil prices were violently skyrocketing, inflation was tearing through supply chains like wildfire, and, well, a massive land war had just broken out in Europe.
Yeah.
And by all traditional financial logic, global investors should have been, running away from the epicenter of the storm. They should have been terrified of the structural damage being done to the global order.
Which is what you would expect, right?
Exactly. But instead, the global financial system did the exact opposite. It took trillions of dollars in panicked capital and relentlessly flooded it into a single asset, pushing it to a 20-year high.
And that asset was the U.S. dollar.
Yes, the U.S. dollar. So, welcome to the deep dive. Today, we're talking about why that happens, because, when you hear energy crisis, you probably just think about the pain at the gas pump.
Right, or you just see headlines about oil shortages.
Exactly. But that framing completely misses the hidden, massive financial machinery firing in the background. So the mission for this deep dive is to reframe energy crises for you. They aren't just commodity stories, right?
No, not at all.
They are massive global macro shocks that rewire inflation, monetary policy, and capital flows. And to help us decode this system, we have our resident macro strategist here.
Thanks for having me. And yeah, the core thesis here, the thing that we really need to unpack, is that the consistent, almost inevitable outcome of a global energy crisis is a massively stronger U.S. dollar.
Which feels super counterintuitive, honestly.
It does. But today we're going to unpack the two powerful forces driving this, the global demand for safety and the expectations of tighter monetary policy.
And how they basically collide to pull the entire global financial system toward the U.S.
Precisely. The instinct is always to look at the gas pump, When energy prices go crazy, we fixate on the physical commodity.
Like the actual barrel of crude oil.
Right. Or the cost to fill up a delivery truck. But that physical reality is really just the trigger mechanism. What actually happened in 2022, and what happens in almost every major energy crisis in modern history, is that the energy shock activates this massive, largely invisible piece of financial machinery.
So it's not just about the oil itself.
No, it rewires global inflation, it forces central banks into a corner, and it violently redirects capital flows.
Okay, so let's tear that machinery apart today and look at the wiring.
Yeah.
Because I feel like if you only think of an energy crisis as a story about oil shortages, you are missing the most consequential macroeconomic earthquake on the planet.
You're missing the whole picture, yeah. We have to look at the structural forces beneath the headlines. I mean, the dollar doesn't strengthen during an energy crisis because investors suddenly feel deeply patriotic about the U.S. economy.
Right, they're not just waving flags.
No, it strengthens because of a brutal collision between human panic and the cold, hard mechanics of global debt.
Okay, so before we can understand why the dollar wins that collision, we have to understand how an energy shock actually starts. Like how it spreads through the system.
Right, the genesis of the shock.
Yeah. Let's talk about that spark. A crisis obviously starts with a supply shock. But what actually causes the pipeline to dry up? I mean, I think most people default to geopolitics, like a war or an embargo.
Sure, the geopolitical triggers are definitely the loudest.
But it's not always a traumatic event on the evening news, is it?
Not always, no. I mean, a coordinated production cut by an oil cartel or sweeping economic sanctions against a major exporter, those cause immediate violent price spikes because supply is literally pulled off the market overnight.
Right, it's instant.
But the most dangerous shocks are often structural and, honestly, deeply quiet. They happen in corporate boardrooms 5 or 10 years before the consumer ever feels the pain.
Oh, wow. So you're talking about underinvestment.
Exactly. The capital expenditure cycle in the energy sector is incredibly long and highly cyclical. Let's look at the decade following the 2014 oil price crash.
Okay, what happened then?
Well, prices were low, so energy companies drastically slashed their exploration budgets. They stopped hunting for new deepwater reserves. They shut down older, less efficient refineries.
Because it just wasn't profitable to keep them running.
Right. And instead of pouring billions into infrastructure that might not pay off for a decade, they returned that cash to shareholders through, dividends and stock buybacks.
So the global economy was essentially just coasting on the infrastructure of the past.
Coasting on depleting assets, yeah.
Yeah.
And while the supply side was essentially on a starvation diet, global demand kept grinding higher.
And then what? It eventually just snaps.
Pretty much. When you have a sudden, violent rebound in global demand, like the world coming out of pandemic lockdowns, for instance, the system breaks.
Because everyone wants oil at the same time.
Right. The global economy suddenly demands 50 million barrels of oil immediately, and the physical infrastructure simply cannot deliver it. You can't just flip a switch and build a deep-water rig. It takes years.
Okay, so regardless of whether the spark is like a tank rolling across a border or some Excel spreadsheet decision made a decade ago, the immediate result is the same. The price of energy surges.
Exactly.
But let's get into why that matters so much more than a spike in the price of, say, lumber or copper.
Yeah.
Why is oil the ultimate contagion? I mean, what makes it so special?
Well, oil is the foundational layer of global GDP.
Okay.
Like, if the price of lithium spikes, an automaker might delay the rollout of a new electric vehicle. Or consumers hold off on buying laptops. You can substitute, you can delay, you can opt out.
Right, you just don't buy the thing.
Exactly. But you cannot opt out of the oil economy. It is the transmission mechanism for every other good on the planet.
It's basically the underlying operating system of the physical world.
That's a great way to put it, yeah.
Like, if you have a smartphone and the manufacturer suddenly dictates that the underlying operating system requires this massive, incredibly expensive, mandatory update.
Yeah.
It doesn't matter what specific apps you use.
Every single app is going to cost more to run.
Right. You can't escape the operating system. Is it the sheer speed of the price increase that shocks the global system? Or just the inescapable fact that no country can just, like, opt out of using oil?
It's the inescapability. That inelasticity is what creates the global macro shock. Take food production, for example.
Okay, yeah.
Modern agriculture is a hyper-energy-intensive process. You need natural gas to synthesize ammonia for fertilizers. You need massive amounts of diesel to power combine harvesters and tractors.
And then you have to move all that food.
Right. You need bunker fuel to put that grain on a bulk carrier and ship it across an ocean. And you need electricity to refrigerate it at the terminal.
Wow.
So when oil goes from $60 to $120, the literal cost of human survival goes up. And because countries cannot simply decide to stop importing food or stop running their power grids, they are forced to absorb that price increase immediately.
They just have to swallow the cost.
Yeah, they have no choice.
And since nobody can opt out of this expensive operating system, the economic dominoes begin to fall. Which brings us to the next phase, right? A really toxic economic environment.
Very toxic.
The initial shock in the commodity market bleeds into the broader economy, and the first symptom is this massive inflationary wave.
Because oil is an input for everything, those price spikes feed directly and aggressively into consumer prices.
Right. The businesses can't just eat that cost forever.
Exactly. A manufacturer paying double for electricity and shipping has no choice but to pass those costs onto the consumer just to protect their margins.
Makes sense.
But what makes energy-driven inflation so dangerous is that it is incredibly broad-based. It's not just the technology sector running hot or like housing prices surging. Everything gets more expensive at the exact same time.
And it's super stubborn, isn't it? A central bank can tweak interest rates all day long, but they can't print barrels of crude oil.
No, they can't. They can't unclog a port or build a refinery either.
So they're just completely powerless over the supply side.
They are totally powerless over the supply side, but the inflation is really only half of the disease.
What's the other half?
While prices are surging, higher energy costs are actively suffocating economic growth. Think about a nation that relies heavily on importing its energy.
Okay, like who?
Germany is a classic historical example. A massive industrial powerhouse, heavily dependent on imported natural gas and oil to run its chemical plants and auto factories.
Okay, so when energy prices double, what happens to their national balance sheet?
Their trade surplus just evaporates. They are suddenly forced to send vastly more of their national wealth out of the country just to maintain the baseline function of their economy.
Man, that is wealth just hemorrhaging out of the domestic system.
Exactly. It leaves way less money circulating internally. And consumers, who are already getting crushed by their utility bills and grocery costs, they immediately cut back on all discretionary spending.
Right, they stop going to restaurants, they stop buying new clothes.
So consumer demand craters while the cost of doing business skyrockets.
Oof, that's a brutal combination.
It is. The businesses see their margins collapsing from the energy costs and their sales collapsing from the squeezed consumer. So they freeze hiring, they cancel expansion plans, they lay off workers.
The engine of the economy just stalls out completely.
Completely stalls out.
Which gives us the ultimate nightmare scenario, stagflation. Stagnant economic growth paired with runaway inflation.
Yes, stagflation.
But hold on, let me push back on that for a second, because that feels economically contradictory to me.
How so?
Well, normally, if we enter a recession and demand falls off a cliff because nobody is buying anything, shouldn't prices naturally come down? Why does the inflation stick around if growth is slowing?
Because the inflation isn't being driven by excess consumer demand, it's being driven by the inescapable cost of supply.
Oh, right, because of the operating system analogy.
Exactly. Even if the consumer buys half as many goods, the energy required to produce and transport that remaining half is still exorbitantly expensive.
Oh, okay.
And this puts policymakers in a lethal bind. Historically, central banks have a very clear playbook. If inflation is high, the economy is running too hot, so you raise interest rates to cool it down.
Right, you make borrowing more expensive.
And if growth is weak and you're in a recession, you cut interest rates to stimulate the economy.
But in stagflation, you have both of those things happening simultaneously.
Right. They are at war with their own mandates. If they raise rates to fight the inflation, they crush whatever tiny bit of economic growth is left, driving unemployment even higher.
And if they cut rates?
If they cut rates to try and save the economy, they pour gasoline on the inflation fire, risking a total loss of confidence in their currency.
Wait, okay, that brings up a huge question. If stagflation is this toxic and inflation is out of control, doesn't high inflation usually devalue a currency?
Normally, yes.
So why does this specific, ugly stagflationary environment actually set the stage for the US dollar to win? Like, why doesn't the dollar just crash?
It's all about relativity. If the U.S. were experiencing hyperinflation in isolation due to, say, domestic mismanagement, the dollar would absolutely plummet.
Because everyone would just move their money elsewhere.
Exactly. But a global energy shock doesn't respect borders. The stagflation hits everyone. It hits Europe, it hits Asia, it hits emerging markets.
So there's nowhere to hide.
Right. The question global capital asks isn't, is the U.S. experiencing inflation? The question is, where is the safest place to hide my money while the entire global economy catches fire?
It's the cleanest dirty shirt in the laundry basket.
Exactly that. And this introduces the first of two massive structural forces that drive the dollar higher during a crisis. The primal flight to safety.
The ultimate safe haven. Okay, let's dig into that.
When you enter a period of profound uncertainty, the psychology of the institutional investor completely inverts.
What do you mean?
Well, during a bull market, a pension fund manager or a sovereign wealth fund is hunting for yield. They are taking risks in emerging markets, they are buying high-yield corporate junk bonds, they are heavily invested in equities.
Because they want to grow their money.
Huh?
They're chasing returns.
Right. But when the stagflationary storm hits...
They stop looking for returns and start looking for pure protection.
Exactly. Return on capital becomes entirely secondary to the return of capital. They just want to ensure the money still exists when the dust settles.
Just don't lose the money.
Right. This triggers a massive systemic risk-off cascade. Capital flees anything with a hint of vulnerability. They dump equities, knowing corporate earnings are about to be crushed by energy costs.
And I imagine emerging markets get hammered here.
Oh, absolutely. They violently pull capital out of emerging market currencies, knowing those smaller energy-importing economies face potential sovereign default.
And as they sell all these risky assets around the globe, they are essentially converting them into cash. But they don't want just any cash, do they?
No, they want the U.S. dollar. The dollar isn't just a popular choice. It sits at the absolute structural center of the global financial system.
It's the world primary reserve currency.
Yes, it is the dominant unit of account for global trade. If Brazil sells soybeans to China, that transaction is largely invoiced and settled in U.S. dollars. It is the foundational bedrock of the international system.
But they don't just hold giant piles of physical $100 bills, right? When hundreds of billions of dollars of terrified capital come rushing into the U.S., where does it actually park itself?
It floods into the U.S. Treasury market, U.S. government debt. When we talk about safety, we aren't just talking about the creditworthiness of the U.S. government. We are talking about market depth and liquidity.
Let's define that for the listener. When a macro strategist says depth and liquidity, what does that actually mean for, say, a frightened billionaire or a massive pension fund?
It means you can move an unbelievable amount of money without breaking the machinery.
Okay, give me an example.
Say a sovereign wealth fund decides they need to liquidate $10 billion of assets and park it somewhere safe by tomorrow morning. They can't buy gold.
Why not? Gold is a safe haven.
It is, but if you try to buy $10 billion of gold in a single day, you will move the price of gold so violently that you ruin your own trade.
Ah, because the market isn't big enough to absorb it smoothly.
Right. And you can't buy Swiss francs either. The Swiss financial market just isn't large enough to absorb that kind of capital tsunami without severe distortion.
So the bunker isn't big enough.
Exactly.
I picture the U.S. Treasury market as essentially the only financial bunker on planet Earth with thick enough concrete walls and a large enough footprint to fit the entire world's wealth when a Category 5 economic hurricane makes landfall.
That's a perfect analogy.
Like if you crowd into the Japanese yen or the euro, the bunker fills up, the oxygen runs out, and the roof blows off. But the U.S. Treasury market is a $25 trillion ocean.
An ocean is exactly right. You can drop a $10 billion boulder into the U.S. Treasury market, and the ripples barely register. You can buy or sell massive quantities of U.S. debt instantly, 24 hours a day, with incredibly tight spreads. During a crisis, liquidity is survival. Investors demand the ability to get their money out just as easily as they put it in. Only the U.S. Treasury market offers that scale.
Okay, but let me interrupt this idea of a psychological flight to safety for a second.
Sure.
Because calling it a flight to safety makes it sound like a preference. It makes it sound like global investors are sitting at a desk, looking at a menu of options, and choosing the dollar because it feels, I don't know, cozy.
Right, like a conscious choice.
Yeah. Is this flight to the dollar just a psychological preference for comfort? Or is there a mechanical mathematical necessity forcing investors into U.S. assets?
It's the latter. The initial panic is psychological, sure. But what sustains the dollar's massive rally, what turns it into an inescapable vacuum, is pure mathematical obligation.
Okay, this transitions us from the psychology of fear directly into the cold, hard mechanics of global debt. It's not just a preference, it's an obligation.
Exactly. The global financial system is built on dollar-denominated debt. This is the concept of the global dollar shortage, and it's all about the plumbing of global finance.
Let's open up the pipes then. What is this plumbing? Unpack this dollar shortage for me.
Well, we have to talk about the euro-dollar system and offshore dollar liabilities.
Okay.
For decades, it has been incredibly advantageous for corporations and governments outside the United States to borrow money in U.S. dollars.
Hold on. That makes no intuitive sense to me.
Why not?
If I'm a massive property developer in China or a telecom company in Brazil, my customers pay me in yuan or reais. Why on earth would I take out $1 billion loan in a currency I don't print and that I don't earn in my daily operations?
Because the local banking systems often lack the capacity to fund massive multi-billion-dollar infrastructure projects.
Well, they just don't have enough capital.
Right. And even if they do, the interest rates in local currencies are historically much higher. The global pool of investors willing to buy U.S. dollar-denominated debt is practically infinite compared to investors willing to buy debt in, say, Brazilian reais.
So the Brazilian telecom company goes to an international investment bank and issues a $1 billion bond.
Exactly. They get cheaper access to vastly more capital.
But they are taking on a massive hidden risk, right? They are essentially taking out a mortgage in a foreign currency.
A massive foreign exchange risk. In normal economic times, it works fine.
Because the exchange rate is stable.
Yeah. The Brazilian company earns reais. They go into the global foreign exchange market, swap those reais for U.S. dollars at a stable exchange rate, and make their quarterly interest payments to the bondholders in London or New York.
Simple enough. But we aren't talking about normal times. We're talking about an energy crisis where the global economy is stalling out.
Right. When the shock hits, the risk-off environment takes over. Global financial conditions tighten violently. International banks become terrified of counterparty risk.
So they stop lending.
They stop lending entirely. Credit lines freeze. The flow of easy dollars in the global banking system dries up overnight.
So the music stops. It's like a brutal game of global musical chairs, where the chairs are U.S. dollars. And when the energy crisis stops the music, everyone violently scrambles for a seat.
That's exactly what it is, because the debt doesn't disappear. That Brazilian telecom company still has a $1 billion loan. They still have a $50 million interest payment due next week.
Oh, man.
And the investment bank in New York does not care that the Brazilian economy is in a recession or that energy prices are crushing the telecom company's margins. They demand their payment in U.S. dollars.
So what does the telecom company do?
They are forced into the open foreign exchange market to buy dollars, but remember, every other debtor on the planet is doing the exact same thing at the exact same time.
Oh, I see.
The supply of free-flowing dollars is shrinking because banks are hoarding cash, but the demand for dollars to service trillions in global debt is utterly inelastic. It is rigid.
So just to clarify this for you, the listener, even if a foreign company has absolutely nothing to do with the U.S. economy, the mere fact that their loans are in dollars forces them to buy dollars at a premium, driving the value up for everyone else.
Yes, they aren't buying the dollar because they think the U.S. economy is doing great.
No, it's like being trapped in a terrible cell phone contract where the cancellation fee goes up every single day, and if you miss a payment, your entire life is repossessed.
They are buying it because the alternative is sovereign or corporate default. They face immediate bankruptcy. They become forced buyers.
And this is where the mechanical squeeze becomes a vicious cycle, right?
Exactly. The Brazilian company dumps their reais to buy dollars. This massive selling pressure crashes the value of the real and spikes the value of the dollar.
Which means tomorrow, when they need to buy more dollars, it costs them even more raise.
Yes. Their local currency buys fewer dollars, which means the actual physical burden of their debt just got heavier simply because the exchange rate moved against them. This forces them to scramble for even more local currency to convert, driving the dollar even higher. It is a relentless mechanical short squeeze on a global scale. It drives the dollar up entirely independent of the U.S. domestic economy's performance.
Okay, let's step back and look at the terrifying architecture of this. We have terrified institutional capital willingly flooding into the dollar for safety, and we have trapped global debtors mathematically forced to buy the dollar to avoid bankruptcy.
Those are two monumental forces.
But then the central banks enter the fray. They wake up, look at the inflation data, and they unleash the second half of this macro shock. Force 2, the yield magnet.
The yield magnet completely changes the incentive structure of the global economy.
How so?
Well, we move from a story about hiding from fear and paying off debt to a story about hunting for return.
Okay, so let's trace the path from oil to monetary policy. How does a spike in the cost of a barrel of crude oil force the hand of the Federal Reserve?
It comes back to the entrenched nature of energy inflation we talked about earlier. When oil spikes, it acts like a virus in the economic data. Right? The initial symptom is high gas prices, but then it metastasizes into the core of the economy. The cost of diesel drives up freight rates. The cost of freight drives up the cost of warehousing.
And the cost of warehousing forces retailers to raise the price of consumer packaged goods.
Exactly. Suddenly, inflation isn't just a temporary blip. It becomes a deeply entrenched, broad-based reality.
And the Federal Reserve, by law, cannot ignore that.
No, they can't. The Federal Reserve operates under a dual mandate: maximum employment and price stability.
Right.
But history, particularly the stagflation of the 1970s, has taught them a brutal lesson. If inflation becomes entrenched, if consumers psychologically expect prices to rise 10% every year, it destroys the foundation of the economy.
Because workers demand massive wage increases to keep up.
Yes, which forces companies to raise prices even higher, creating a self-sustaining wage price spiral.
To kill the virus, the Fed has to administer this like toxic chemotherapy.
They use the only blunt instrument they have, the federal funds rate. They raise interest rates.
By making it vastly more expensive to borrow money, they aim to destroy demand.
Exactly. They want to make mortgages too expensive so housing cools down. They want to make corporate borrowing expensive so companies stop hiring. They intentionally try to slow the economy to a crawl to break the back of inflation.
Man. So how do the currency markets react when they realize the Fed is about to go to war with inflation?
There's a violent repricing of expectations. Before the energy shock, traders might have assumed the Fed would keep money cheap to support the economy.
But the moment energy inflation takes hold,
Traders realize the Fed has to pivot. They begin to price in an incredibly aggressive, hawkish monetary policy. They expect rates to go up sharply and stay up for a long time.
but why does a higher interest rate in the U.S. magically make the U.S. dollar stronger against, say, the euro or the yen?
Because capital is essentially nomadic. It roams the globe, constantly searching for the highest risk-adjusted return. When the Fed raises rates, It directly increases the yield, the interest paid on dollar-denominated assets. Suddenly, that incredibly safe U.S. Treasury bond we talked about isn't paying a negligible 1% interest rate. It's paying 4% or 5%.
Wait, I have to point out the incredible contradiction of this dynamic.
What do you mean?
This sounds like an absolute cheat code for wealthy investors. You're telling me that during a global economic meltdown, investors get to hide their trillions in the single deepest, safest financial bunker on planet Earth, the U.S. Treasury market, ND. They get paid a premium, high-interest yield to do it.
It is the ultimate macro anomaly.
How does this dual magnet of safety plus yield compare to regular non-energy financial crises where central banks usually cut rates? Like, think about 2008.
Right, 2008 is the perfect contrast.
The housing market collapsed, the banks were failing, the world was ending. Capital flooded into U.S. Treasuries for safety. But the Fed slashed interest rates to absolute zero to try and save the banking system.
Yes.
So if you hid in the bunker in 2008, you got safety, but you made zero money. Your yield was nothing.
That is the crucial distinction. In a deflationary financial crisis like 2008, the central bank cuts rates to stimulate growth. Safety comes at the cost of yield.
Wow.
But an energy crisis is inflationary. The central bank is forced to hike rates into the economic weakness to kill the inflation. So investors get safety, and they get a massive risk-free yield.
It's an irresistible proposition. Capital is sucked out of the rest of the world and fired into the U.S. not just to hide, but to make money.
It acts like a gravitational black hole for global wealth. But to really understand the power of this black hole, you have to look at what the rest of the central banks are doing.
Or rather, what they're failing to do.
Exactly.
Right, because the U.S. Federal Reserve isn't the only central bank on Earth. You have the European Central Bank, the Bank of Japan, the Bank of England.
Right.
If the Fed is raising rates to fight inflation and offering this massive yield to protect the dollar, why don't Europe and Japan just do the exact same thing to protect their own currencies?
Because they face a fundamentally different and far more brutal physical reality. This is the concept of the unfair advantage.
Okay, unpack that.
They cannot match the Federal Reserve step for step because their domestic economies are structurally crippled by the energy shock.
Give me the mechanics of that. Why is a high interest rate in Europe more dangerous than a high interest rate in the U.S. during an oil shock?
Let's look at the European Central Bank. Europe is a massive manufacturing hub that is heavily reliant on imported energy historically, Russian natural gas and Middle Eastern oil.
Right.
When global energy prices spike, the input costs for German auto manufacturers and chemical conglomerates skyrocket. They are already teetering on the edge of insolvency just from the utility bills.
Their margins are obliterated.
Obliterated. Now, imagine the European Central Bank steps in and says, inflation is high, we are going to hike interest rates by 300 basis points to fight it.
Oh boy.
Suddenly, those same manufacturing companies, which are bleeding cash to pay for natural gas, now face skyrocketing borrowing costs to roll over their corporate debt.
You would instantly bankrupt the industrial core of the continent.
You would plunge the entire region into a devastating deep depression. So the ECB and similarly the Bank of Japan are trapped.
They can't hike rates without destroying their own economies.
Right. They have to move much more slowly and cautiously than the Federal Reserve. They might hike rates a little bit, but they cannot afford to be aggressive.
And this hesitancy creates a massive gap.
We call it an interest rate differential. Because foreign central banks delay their rate hikes, U.S. interest rates rise much faster and to a much higher terminal rate.
So the gap widens significantly.
Exactly. If a safe U.S. government bond is paying 5% and a relatively riskier European bond is only paying a 2% because the ECB is afraid to hike, the math is indisputable.
Capital flows relentlessly across the Atlantic, selling euros and buying dollars.
Precisely.
I picture this like a marathon analogy. It's like two runners racing, but one runner, say Europe or Japan, is suddenly forced to carry a 50-pound backpack of imported energy costs.
It's a great way to visualize it.
But there is a structural layer underpinning why the U.S. economy can actually handle those 5% interest rates without instantly imploding like Europe would.
Yes, a very important structural layer.
Does the modern U.S. shale revolution fundamentally change the historical playbook? Has it given the U.S. a structural superpower during energy crises that it didn't have a few decades ago?
It absolutely has. It is a massive paradigm shift in global macroeconomics.
Because if we were having this conversation in the 1970s or the 1990s, the U.S. would be in a very similar boat to Europe, right?
Exactly. The U.S. was a heavy net importer of foreign oil. An energy crisis meant a massive wealth transfer straight out of the American consumer's pocket and into the Middle East. It hollowed out the U.S. trade
What's
balance.
about map changed?
The technological advancements in hydraulic fracturing and horizontal drilling, the U.S. shale revolution, completely rewrote the global energy map.
Okay.
Over the last 15 years, the United States transformed from a vulnerable importer into a dominant swing producer of energy. The U.S. is now often a net exporter of petroleum products and liquefied natural gas.
Now, I want to make sure we don't paint this as a utopia, because when oil hits $120 a barrel, the person driving a truck in Ohio or Texas is still getting absolutely crushed at the gas pump.
Oh, absolutely, they do.
The domestic U.S. consumer still feels the brutal sting of inflation.
Inflation still ravages the U.S. working class, without a doubt.
Hmm.
But you have to look at the macro-level sovereign balance sheet.
Okay, what does that mean in practice?
When the U.S. was an importer, high oil prices meant money left the country. Today, high oil prices act as a massive tax on the U.S. consumer, but that tax is paid to massive U.S. domestic energy companies in the Permian Basin.
Oh, wow. It's an internal transfer of wealth rather than an external hemorrhage.
Exactly. Those U.S. oil companies report record profits, they increase domestic capital expenditure, they hire more engineers and rig workers.
The energy shock actually sparks a boom in a massive sector of the American economy.
Yes. So while Europe is purely experiencing an economic bleed, the U.S. economy has a built-in shock absorber.
And global capital, which is ruthless and unsentimental, looks at this structural reality and makes a very simple calculation.
Capital evaluates relative resilience. In a crisis, money compares economies. It looks at Europe, entirely dependent on foreign energy, facing a crippling recession, and managed by a central bank terrified to raise rates.
And then looks at the U.S.
Right. Energy independent, structurally insulated, with a central bank aggressively hiking rates to defend the currency and offering massive yields.
The choice is a no-brainer.
The choice is made in a microsecond by trading algorithms. The capital naturally gravitates to the United States, crushing the currencies of importing nations in the process.
Wow. Okay, so we've built an incredible theoretical and mechanical case here. We have the psychological flight to safety, the euro-dollar debt squeeze, the interest rate differentials, and the structural insulation of U.S. shale.
That's a lot of forces, yes.
But there's a purely transactional, physical layer to this that we haven't touched yet.
The oil trade mechanics.
Right. The actual physical buying and selling of the millions of barrels of crude oil that move across the oceans every single day. That creates a massive, continuous bid for the dollar, doesn't it?
Yes, this is the petrodollar system, and it is arguably the most relentless mechanical force driving the currency.
Explain that for us.
It all stems from one historical foundational reality of global trade. Crude oil is priced, invoiced, and settled primarily in U.S. dollars.
Whether it's a tanker leaving Saudi Arabia headed for Tokyo or a pipeline running from Norway to the UK.
The currency of exchange is the U.S. dollar. Now let's walk through the math of transactional demand during a crisis.
Okay, lay out the math.
Let's say an emerging market nation needs 1 million barrels of oil a day to keep its power grid and transportation sector functioning. At $50 a barrel, that nation's central bank and energy importers need to source 50 million U.S. dollars from the foreign exchange markets every single day to pay the exporters.
Right. They sell their local currency, buy $50 million, and hand it over for the oil.
Now the supply shock hits. The price of oil violently gaps up to $150 a barrel.
Okay.
The nation's physical requirement hasn't changed. They still fundamentally need that 1 million barrels of oil to prevent their society from collapsing.
Right, the inelastic demand we talked about.
Exactly. But now, mathematically, they are forced to enter the FX market and acquire 150 million U.S. dollars every single day.
Just to maintain the exact same volume of oil they had yesterday.
Yes. They aren't buying more energy. They are just forced to buy exponentially more U.S. dollars, and they have to dump their local currency on the open market to get them.
Which creates this massive, sustained, daily transactional demand that relentlessly pushes the dollar's value higher.
And that is only the beginning of the petrodollar cycle. We have to follow where those dollars actually go once they leave the importing nation.
Well, they flow into the treasury accounts of the major oil exporting nations, right? The sovereign wealth funds of the Middle East, the energy conglomerates.
Right. And those entities suddenly find themselves accumulating unprecedented, massive windfalls of dollar revenue, hundreds of billions of dollars in excess cash.
So what do they do with it?
They don't just leave that cash sitting in a checking account, and they certainly don't convert it into their local, smaller currencies. They engage in what the financial world calls petrodollar recycling.
They take the wealth they just extracted from the global economy and they reinvest it.
And they recycle it directly back into the deepest, most liquid financial market on Earth, the United States.
Of course they do.
They buy massive tranches of U.S. Treasury securities. They buy U.S. corporate bonds. They buy premium American real estate and massive stakes in U.S. equities.
So the dollars that were drained from energy importers in Asia and Europe are funneled directly back into the American financial system.
Exactly.
Okay, I need to push back on the math here, because on a superficial level, it sounds like a perfectly balanced, closed-loop equation.
How?
Well, the dollars go out of the global system to pay for the expensive oil, and then the oil exporters turn around and put those exact same dollars right back into U.S. treasuries. If the money just goes out and comes back, doesn't it just cancel out? How does that cycle actively strengthen the dollar rather than just maintaining the status quo?
It's a vital question, but it completely misses the nuance of financial liquidity.
Okay, explain the nuance.
It is not a one-to-one cancellation. You have to look at the form the money takes. When an importing nation in Asia desperately buys dollars to pay for oil, they are taking liquid, circulating capital out of their domestic banking system.
That is money that could have been used to fund local business loans or build local infrastructure.
Right. They hand that liquid cash to the exporter.
Okay, the cash leaves the system.
Now, when the sovereign wealth fund of the exporting nation recycles those dollars, they don't deposit them back into the commercial banking system of the Asian importer.
Oh, whoa.
They take those dollars and they lock them up in U.S. financial assets. They buy a 10-year U.S. Treasury bond.
Ah, I see.
The dollars return to the U.S., but they are sequestered. They are locked away in long-term financial instruments. They are no longer freely circulating in the global banking system for other countries to use to service their debts.
So this recycling process effectively vacuums up global dollar liquidity and locks it in the American vault.
Exactly. It severely exacerbates the dollar shortage we talked about earlier.
It literally starves the rest of the world of dollars.
It starves them. The emerging markets and importing nations are desperately scrambling for a shrinking pool of circulating dollars to pay their corporate debts and buy their next barrel of oil.
Meanwhile, the U.S. financial system gets flooded with an incoming tsunami of petrodollar capital.
Which drives U.S. asset prices up and pushes the currency even higher. It is a massive structural drain of global wealth directly into the U.S. dollar.
Okay, we have meticulously stacked up an unbelievable confluence of forces here. We have structural advantages, debt traps, and petrodollars. But markets aren't just abstract theories.
No, they're not.
They are run by human beings, they are run by hedge funds, proprietary trading desks, and increasingly by algorithms. How do the actual humans trading these markets react when they see this perfect storm forming?
This is the final explosive phase of the dollar's rise, the amplification.
Amplification, okay.
Financial markets are incredibly forward-looking mechanisms. Traders and algorithms don't wait for the economic data to be published in a quarterly textbook. They act on the alignment of macro forces the microsecond they perceive them.
And what they perceive during an energy crisis is a remarkably rare, highly potent combination.
Extremely rare.
Rare in what sense? Don't crises always look somewhat similar?
Not at all. In most standard financial crises, the major forces push in opposite directions.
Like what?
Think about a standard recession. Fear goes up, so investors naturally buy the dollar as a safe haven.
Yeah.
That pushes the dollar up.
Right.
But simultaneously, the Federal Reserve slashes interest rates to zero to try and rescue the economy. The collapsing yield makes the dollar less attractive, pushing the dollar down.
So the forces oppose each other.
Exactly. Resulting in a volatile but somewhat constrained currency move.
But in an energy crisis, those forces aren't opposing each other.
No, they are violently aligned. You have intense global risk aversion and panic causing capital flight into the dollar.
Right.
And happening at the exact same time, you have hawkish monetary expectations, the Fed aggressively hiking rates to fight energy inflation, offering massive yields.
So fear tells the market to buy the dollar, and yield tells the market to buy the dollar.
It's a green light across the entire board. Both forces pushed in the exact same direction.
So what do the institutional traders actually do with that information?
They position for it with ruthless aggression. Let's look at leveraged hedge funds and macro traders. They survey this landscape, and they rapidly unwind their risk-on portfolios.
They slash their emerging market exposures.
Yes. They aggressively short the currencies of energy importing nations. They will literally borrow capital to bet against the euro or the Japanese yen. And conversely, they dramatically increase their long positions on the US dollar. They use leverage to amplify their bets that the dollar will continue to surge.
They are essentially pouring lighter fluid on a fire that is already burning.
And then you add the algorithms.
Oh man, the bots.
Right. Trend-following bots, known as CTAs, scan the market for momentum. As the structural forces and the hedge funds push the dollar higher, these algorithms detect the upward moving averages.
And the math dictates they must jump on the trend.
They start automatically buying massive amounts of dollars, completely devoid of human emotion.
And what happens to the people who are betting against the dollar? Like the people who thought maybe the U.S. economy would stumble.
They get caught in a mechanical slaughter known as a stop-loss cascade.
Explain that.
Imagine you are a trader who shorted the dollar, betting it would go down. You have a built-in safety net, a stop-loss order, which automatically buys the dollar back if the price goes too high, to prevent you from losing your entire fund.
You just tap out to limit the damage.
Exactly. But when the hedge funds and the algorithms violently push the dollar higher, they start triggering those stop-loss orders.
Oh, no.
The traders betting against the dollar are mechanically forced by their own risk systems to buy the dollar to cover their positions.
Which means more buying.
Yes.
Yeah.
This forced buying pushes the price even higher, which triggers the next level of stop losses, which forces even more buying.
It's a self-fulfilling prophecy on fast forward.
The market mechanics take the fundamental reality of the energy shock and put it on steroids. What would have been a gradual structural appreciation based on trade balances and interest rates turns into a sharp, violent, parabolic upward move.
It becomes a runaway freight train.
And it crushes anyone standing in front of it. This positioning turns a gradual structural appreciation into a sustained upward move for the dollar.
So bringing this entire monumental system back to reality for you, the listener.
Yeah.
For the person listening to this deep dive who's just trying to make sense of global markets, is monitoring oil prices essentially a cheat code for predicting global liquidity flows?
It is the ultimate fundamental decoder ring. If you understand the mechanics we've discussed today, you will never look at an oil price spike the same way again.
Right. You won't just see a reason to complain about the cost of a road trip.
No, you will see the activation signal for the most powerful macro machine on Earth. When oil spikes and remains structurally high, you immediately know the sequence of events that must follow.
Okay, let's summarize that reinforcing inescapable cycle for the listener. Because higher energy prices drive inflation, right?
Right. You know inflation is going to embed itself in the supply chain.
And that entrenched inflation drives tighter policy expectations.
You know the central banks will be forced to aggressively tighten policy into an economic slowdown.
And then that tighter policy attracts capital.
Yes. You know, the global corporate sector will face a devastating dollar shortage as they scramble to roll over their debt. You know, petrodollars will vacuum liquidity out of emerging markets.
And global uncertainty channels all that capital directly into the dollar.
You know, with almost mathematical certainty, that a massive structural wave of capital is about to flow directly into the US dollar. You can essentially map out the next 12 to 18 months of global macro movements simply by understanding the financial plumbing triggered by that single physical commodity.
It is a staggering, inescapable chain reaction. It starts with a simple failure to drill enough wells 5 years ago, or a geopolitical conflict disrupting a pipeline.
Exactly.
That supply shock makes the operating system of the global economy violently expensive. It instantly drives broad, inescapable inflation. That stubborn inflation forces a massive shift in central bank policy, driving tighter interest rate expectations from the Federal Reserve, which creates a massive yield magnet.
And meanwhile, the sheer economic terror of stagflation happening everywhere else channels all terrified global capital directly into the safest, deepest bunker on Earth, the U.S. Treasury market.
And beneath it all, forced petrodollar buying and the brutal reality of offshore dollar debt mathematically guarantee that the buying pressure never lets up. Oil isn't just a commodity, it's the trigger that activates fear and inflation simultaneously.
It emphasizes why this dynamic is so deeply ingrained in the modern financial architecture. The dollar's strength during an energy shock isn't an anomaly, and it isn't an accident.
It's literally the system working exactly as it's designed.
It is the global financial system working exactly as it is currently structured to work. The mechanics demand it.
Which leaves me with one final, deeply provocative thought to leave you with as we wrap up this deep dive.
Okay, what is it?
We have spent this entire time establishing that the global financial system's absolute, mathematically hardwired survival mechanism during an energy crisis is to violently flood into the US dollar.
Right.
That mechanism relies on two things. It relies on the petrodollar system, and it relies on crude oil being the inescapable operating system of the physical economy. But what happens if that operating system changes? If the world eventually transitions away from oil entirely over the next few decades, if the petrodollar is dismantled and energy becomes hyper-localized through renewables, changing the very nature of how power is priced and traded globally, does the US dollar eventually lose its ultimate crisis superpower?
That is the million-dollar question. If the underlying commodity that links global debt, trade, and inflation fundamentally changes, the entire plumbing of the macroeconomy has to be rebuilt from scratch.
Yeah, that is something to keep in the back of your mind as the world navigates the coming decades.
Absolutely.
Thank you so much for joining us on this deep dive. We hope that the next time you see a headline about oil prices spiking or you're standing there at the gas pump watching the numbers tick higher, you don't just see a localized commodity story.
You're seeing the whole system move.
Exactly. We hope you can visualize that massive, invisible financial machinery firing up beneath the surface, rewiring the global economy, and pulling the world's wealth toward the dollar. Until next time.